Welcome to Financial News Daily. Every week on this channel, we ask one question that most financial coverage never bothers with. Not what happened, but what it means for you, specifically, if you had been watching closely and had acted on it. This week the question is this. If you had understood one single pattern 6 months ago, you would have predicted nearly every major gold move of 2026. Not perfectly, but well enough to have avoided the mistakes that cost most gold investors the most money. What is that pattern? Oil goes up. Gold goes down. Oil goes down. Gold goes up. That is it. That is the pattern that has driven gold in 2026 more than any other factor. Not the war. Not central bank buying. Not government debt. Not the dollar. Oil. And its connection to Fed expectations. Let me show you exactly how this played out. February 28th, the conflict begins. Oil starts rising immediately. Gold, which had been near $3,250, does something that surprises most people. It initially falls. Why? Because rising oil means rising inflation. Rising inflation means the Fed is under pressure to hike rates. And when rate hike expectations rise, gold, which pays no yield, becomes more expensive to hold relative to Treasury bonds. Then something else happens. The conflict escalates further. Geopolitical fear enters the picture. Money that usually sits in equities and bonds looks for something that is not correlated to the financial system. Some of it goes to gold. Gold starts rising. It goes from $3,200 to $5,589 by late January. At the peak, most financial media said, gold is rallying because of the war. That was half right. Gold was rallying because of the war's effect on the monetary system, on inflation expectations, on Fed credibility, on the structural case for real assets. But it was also being pushed by something less durable. Momentum. Fear buying. Investors who did not understand the mechanism but knew that gold was going up and wanted to participate. Then the Fed becomes more hawkish. 3 members dissent in favor of immediate hikes. The September hike probability moves toward 80%. And the momentum buyers, the people who bought gold at $4,500 and $5,000 because it was going up, not because they understood why, sell. Gold falls from $5,500 to below $4,000. Nearly 30%. The people who lost the most in that move were not the people who misunderstood the war. They were the people who had no framework for why gold was moving at all. They bought into the momentum. They had no thesis. And when the move reversed, they had no reason to hold. Now here is where it gets interesting. Gold rose to a 10-week high this week as inflation data came in at 3.4% for the second consecutive month. The September rate hike probability dropped from nearly 50% to around 40% in a single session. CNBC. The same pattern. Oil retreated slightly on ceasefire rumors. Inflation expectations eased. Fed pressure reduced. Gold rose. If you had known the pattern in February, oil up means gold under pressure, oil down means gold supported, you would have understood why gold fell from the peak. And you would have known what to watch for to call the recovery. The recovery catalyst was not the war ending. The war is not ending. Escalating rhetoric between the US and Iran amid stalled negotiations further reduced expectations for an imminent agreement. CNBC. The recovery catalyst was 2 consecutive months of softer inflation data, which gave the Fed permission to stay on hold, which reduced the opportunity cost of holding gold, which brought buyers back. Now suppose you are watching this right now with $50,000 in savings. Most people in that position are asking, should I buy gold? That is the wrong question. The right question is, what is my thesis for gold? If the thesis is that the September hike probability keeps falling, gold may continue rising through August. If the thesis is that oil recovers on renewed conflict and pushes August inflation back up, gold faces renewed pressure. Both scenarios are genuinely possible. The ceasefire rumors that moved oil yesterday were denied by Iran hours later. The strait remains disrupted. The August oil price is the variable that determines the August inflation print. And the August inflation print, due September 11th, determines what the Fed does on September 17th. The people who lose money in gold are the ones who make a directional bet without understanding the chain. The people who preserve money in gold are the ones who understand that they own it because the structural case, government debt, central bank buying, dollar credibility, is durable beyond any single Fed meeting or inflation print. And they size it accordingly. Not so much that a 30% correction destroys them. Not so little that a 67% rally means nothing to their overall position. That sizing discipline, not the direction call, is the thing that actually separates the investors who navigated 2026 from the ones who did not. Everything here is for informational purposes only. This is not financial advice. Please consult a qualified financial advisor before making any investment decisions. The pattern has been oil down, gold up all year. If you had known it in February, what would you have done differently? Comment below. We do this every week. Stay informed. Stay ahead. Financial News Daily.